joining us. My name is Michelle Kessel-Harbart. This is Ken Brown, and this is Our Take. Today we're going to talk about market risk and how we quantify risk. So what is market risk? Market risk is the risk that your investment will decrease in value based upon changes in market factors. And there are a variety of market factors that can change rapidly, and this gives you price volatility. We want to avoid being reactionary to this volatility, and rather than focus on the day-to-day movement of stocks or the market, moving up one day, down the next, we look at a variety of metrics. And this can affect pricing, and we apply a weighting system to the individual stocks in the market. Ken, will you explain to us the key risk factors and how we analyze these to evaluate risk and what we're doing when we're structuring and managing portfolios?
Absolutely. So in no particular order, we're going to run down a list of some of the risk factors that can affect us, not only on an individual stock basis, but also in the stock market in general. And so without further ado, and this is again in no order, one of the risks that we're facing now, we see it in particular with the COVID virus, is business disruption risk. And it's real easy to pinpoint certain industries that have been almost entirely disrupted. For example, the airline industry or the cruise ship industry have been virtually shut down since the early part of March. And so that's one form of disruption, and this is sort of this this black swan event that that impacts certain segments of the economy very hard. And then another ongoing disruption factor would be the changes that are brought about by technology. And so you can see one technology supplanting another over a period of time. And this is actually an accelerating risk, and we see it with the particularly in software. You see it in areas like, for example, the cloud, where companies used to sell servers to an individual company like AT&T, for example. Well, AT&T today may do a lot of their business off of the cloud, which means that it's outsourced, which means that they're no longer buying as many servers as they once did. So it's definitely impacted that business. Another type of disruption might be something like Heinz Corporation's experiencing with the drop in ketchup sales, and that can largely be attributed to changing tastes. For example, young people now have a taste for salsa. It's supplanted ketchup as being the #1 condiment, again, negatively impacting Heinz. A second risk is balance sheet risk. So high levels of debt can be very risky if revenues are unstable, as can be the case in a cyclical industry or in a period of disruption, as we just described. This would be a classic case that we're experiencing today. So, Warren Buffett's basic famous line is, who's swimming naked? You can see who's swimming naked when the tide goes out. And this certainly applies to balance sheet risk. And again, we will overweigh that risk now because, again, we're seeing a lot of disruption. And for example, I just saw the earnings report this morning for Union Pacific Railroad. They're still making money, but revenues are down 24%, and their train loads are significantly down. So again, this is a situation where they have a fairly strong balance sheet, so they'll get through this, but you're seeing a significant disruption, going back to our first risk. A third would be headline risk. So for example, China retaliates in a trade war by cutting off 5G chipset shipments. Semiconductor and equipment markets plummet. This is kind of an unknown variable. We can't really plan for it necessarily, but we can see a heated environment when we see things like tariffs and trade wars. Then you can anticipate that there are going to be some areas that are going to be pinpointed by different governments, whether it's in Europe, China, United States, Mexico, Canada, that kind of thing. So We look out for headline risk, and it's not specific to necessarily geopolitical situations. It can be any number of things. You'll all recall, well, maybe you don't. This is so many years ago when Johnson & Johnson had a huge headline risk factor with Tylenol, or when Coca-Cola, again, many years ago, changed their basic formula on the original Coke, and again, causing, as the headlines came out, causing the stocks to plummet. A fourth would be, we're going to group these together, would be inflation, interest rate, and risk premium risk. It's very important. And so we, again, want to underline this as something that we're going to overweigh because inflation now is very low, and it's allowed the Federal Reserve basically to the ability to keep interest rates at practically zero. This despite historically high levels of debt issuance. So with bonds yielding practically nothing, investors have more or less been forced, or at least pushed, into higher risk investments, i.e. stocks. So this in turn is driving up valuation, and with higher valuation, higher risk. So we watch this like a hawk, as do most serious market participants. 5, this course leads into what we just discussed with valuation risk. So are we overpaying for future earnings of a given company? Is the market currently, or a specific company currently overvalued? With a historical price earnings ratio of 14 to 15 times for the S&P 500, is 22 times next year's earnings too high? This is not a yes or no answer, actually. What can be a short-term overbought situation can essentially grow revenues and earnings over several quarters as the stock market flatlines to adjust to a fairer value. And we can actually see the PE ratio decline. The consistency of growth and the predictability of long-term growth can make a stock with a higher PE a better value than another stock that trades at a lower multiple. This is an overweight. This is obviously something that is not baked in. Different market participants are going to have different risk tolerances for valuation. We're seeing now a confluence of opinion as to where the market is and where individual stocks are. But as I just pointed out, if we're overpaying in the near term for a high growth, high quality, consistent company, oftentimes over time, the earnings will essentially drive the PE ratio down. 6 is foreign exchange risk, or currency shifts. And we read a lot about the dollar going up or down against a basket of foreign currencies on any given day. How can that impact a company's sales, revenues, or earnings? Well, if the dollar's strong, American goods and services cost more to overseas buyers. Or in a financial transaction, any appreciation or depreciation of the base currency, or the appreciation or depreciation of the denominated currency, will affect the cash flows emanating from the transaction. Most multinationals are going to hedge currency risk to some degree. In times of high volatility and price fluctuation, hedges become more widely used. We view this as a lower to medium risk. Again, something that's foreseeable, something that most companies, especially larger companies, are able to deal with. A seventh risk is legislative risk. For example, we know now that we probably are going to see a need for more tax revenues to help defer the massive borrowing for COVID-19. So could corporate tax rates go from 20 to 28%? Yes, to answer that. And companies would then, in effect, bring less to their bottom lines after taxes. So this is a real scenario that's likely to play out over the course of 2021 and into 2022 after the elections. Sort of a slow burn that market participants see coming, and so they can model for this as time goes forward. And keep in mind, a lot of the largest companies in the Fortune 500, for example, have tax strategies where they'll pay tax overseas in places like Ireland at much lower levels and run much of their business offshore. So that, again, the models are adjusted. We tend to downplay somewhat this tax benefit that companies have seen over the course of the last several years. We tend to focus more on top line revenue growth than we do on after-tax bottom line numbers. Bottom line numbers are often easily manipulated, so we give that kind of an equal weighting, if you will. So some other risks that we won't necessarily go into great depth on are detection risk, which is accounting fraud. We all remember Enron, or at least so long ago, maybe some of you don't. But anyway, Enron is a good case in point. Another risk is management turnover, obsolescence risk, where what you're making is no longer in demand or in the marketplace. And just simple things like missed guidance. A company sends a message earlier in the quarter that they're going to hit certain numbers, they come in under, and again, the stock underperforms. So those are just some of the, maybe a top 10, if you will, of risk factors that we look at. There are obviously many more, some more nuanced, but I think this is a good primer for some of the things that we look out for.
Thank you. As you can see, there's many variables to consider when structuring and managing a portfolio, and this is what we do for our existing clients. If you're not an existing client and you're an investor and you're looking for some professional assistance, we'd love the opportunity to speak with you about this in greater detail. So that's it. That's all we have today. I hope you enjoyed it. Take care, stay safe, and we'll see you next time.
Absolutely. Thank you.
Bye-bye.